Welcome to the Lighthouse Financial Advisors Money Over 50 podcast with Dallas Davison and Michael Hogue. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Lighthouse Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. Today our topic, you can't take away risk, you can only shift it. Michael, your topic today, what are you talking about?
Thanks, Dallas. You hear people talk all the time about risk and what they're referring to generally when they're talking about it in the context of their retirement savings or their superannuation.
Yep.
They're nearly always talking about market risk.
Yep.
And market risk is it's the up and down movement of what they're actually invested into. So people say to me all the time, is that high risk?
Yes.
Or is that low risk?
Yeah.
So the assumption is that you can
get rid of risk.
You can get rid of risk.
That you can move out of risky investments. And that you will have no risk. So
you're spot on. Thanks for that, because I was struggling to put that into words. But no, you're spot on. So there is an assumption there that you can take away risk.
Yeah.
And my statement is that you can't take away risk. You can only shift it.
Yeah.
And what I mean by that is that when you take away things like market risk, and what we're referring to there again is
up and
what
down
most people are referring
movement.
to is the up and down movement.
Yeah.
Of what they're invested into. So people will say naturally, the closer I get to retirement, the less volatility that I want.
Yep.
Now, the trade-off with that is that the returns are lower as well.
Yep.
Which introduces a whole nother risk.
Yeah.
And that risk is purchasing power risk, or let's call it running out of money
risk. Yeah. And that's I think as you say there, in every other aspect of our life, people understand that there's no such thing as a free lunch. You don't get, if you could just magically move out of, if you could just avoid if you insure your house, you want to avoid the risk of, I'll be financially ruined if my house burns down. So what you do is you pay an insurance premium, but there's a cost to that. You've got to give something up. That's right. You are in your terms, you're shifting that risk from yourself. You are paying the insurance company to take that risk on for you, but you can't get rid of it. There's no magic way to click your fingers and go, well, I don't want that risk. I'll just get rid of it completely.
You're spot on. If you'd invested, if you said I'm going to run the risk of not insuring my house, and you'd invested all of your insurance premiums, you'd be sitting on a healthy sized investment right now. Now, certainly not saying to do that, but that's a great example there because there is there's certainly a trade-off there.
And I think in every other aspect, even of our financial lives, with financial planning, people can understand that there's no, again, I keep using that phrase, there's no free lunch. But I tell a story about clients of mine. It was really funny actually. That one of them said, we're sick of paying all this maintenance bills on this big house we've got. It just costs so much money and insurance and maintenance, and it's so much work to keep it up. I said, well, sell it then. I said, well, no, but it's our kids' home and we really like having it. It's where they've grown up and we really like having a big house. I said, all right, we'll keep it then. I said, yeah, but we don't want to pay all this. And this went on 3 or 4 times until eventually one of them realised, so what you're saying is just make a decision. There's a trade-off here that has to be made. Make the decision and then move on. But you can't say, I want the big house and I want to, enjoy that, but I don't want to have to do any maintenance and I don't want to have to pay insurance bills and I don't want any of those sorts of things. So in every other aspect of our life, people can see that there is a trade-off that needs to be made, and there's a decision that needs to be made as to whether you shift resources to one area or the other. But I think this is the point that you're making. I'd agree with this completely. When it comes to risk, as a whole, society, everything that we see on the news, everything that we see in our discussions with people about money, risk only refers to, will the price of this thing go up and down?
Yes, and look, to be fair as well to the consumer, our industry has. I'm going to jump on my soapbox here. Yeah. Our industry has been responsible for this a lot of the time, and it's the compliance departments of the large, I guess the large financial licensees that have really been responsible for this as well. So they've actually added to the problem. Yes. What you'll find is that even those this industry has largely talked about risk as a one-dimensional thing. That's exactly and the one-dimensional thing is can you accept the volatility of your portfolio moving up and down? I can, but I can only accept much of it. A 15% fall, not a 30% fall. Okay, this puts you into this category, which means so never has there been a discussion, or there is with us, like we have this discussion with our clients, of course. The discussion about the trade-off for that is that there's lower returns, which means we now have to
save more money,
or
spend less
or
in
you
retirement.
spend less in retirement, or you work longer. I know we don't want to do that. Okay, well let's have a look at this now. Let's look at the trade-offs that we can make. So
and that's why there are a lot of different types of risks, and I actually wrote a couple of blog posts about all the different. I guess the point that I've written blog posts about all the different types of little risks that apply to things that people don't tend to think about and that they need to be aware of when planning for their retirement. But the two big ones, these two, your market risk and running out of money risk, those are the reason we talk mainly about them is it's such a clear-cut trade-off. You have to accept you can only shift from one to the other. There is no way to minimise the. And this is, I guess, the thing, again, as an industry where we've fallen down in previous years is a lack of education around acceptance that this is how it is. It's very much where I think a lot of advisors have gone wrong is to try and pretend that, well, we can have our cake and eat it too. We can get these great UBIT returns, but no, the market will never drop. You'll live forever. It's not going to happen. Yes. We are better off actually having an adult discussion about what's the trade-off of these risks and where are you willing to shift the risk to? So
to use an example, if we wind back the clock to the start of 2010 and imagine for a moment we have two people that have retired, two separate families. One family has their superannuation with Q Super and they've never made an election to invest in anything particular.
So
inside of Q Super.
Default option.
So they've gone into the default option. So they would be shifted into Q Super's Lifetime Sustain 2 fund. I'll talk more about target dated funds. This is what's called a target dated fund, which I think are just wrong. And I'll talk more about that in a minute.
But I guess that's
people have been shifted automatically into that fund if they are over 58 years of old, 58 years of age, which we assume they are. They're retired, they're retiring, and they have a balance of more than $300,000. So they would have been moved into the investment strategy of Lifetime Sustain.
They always sound so good, these investment options, don't they?
They do.
Like if someone said to me when you're 65, hey, you've got to retire now, do you want your money in the Lifetime Sustain option? Sounds great. I want to sustain it for my lifetime. That's fantastic.
That's right. Now the hidden thing behind that nice marketing name is, look, what they've assumed for these people is that what they want is lower volatility.
Lower market risk.
Lower market risk. Now, what that has come with over the last decade, and these are the factual returns as of Q Super's website to the 31st of December 2019, the average rate of return per annum for that per year for that decade has been 3.64%. So on average, in when you started your retirement in 2010, you had your $1 million. It made a 3.64% return, which was $36,400. Hey, you actually needed to spend $60,000 if you were the average retiree of our clients at that point in time.
So your balance has dropped from $1 million to $975.
That's the problem. You've gone backwards straight away. So you've spent $60,000, you made $36,400. So you're on the back foot straight away. So
Yeah.
for 2011,
Yeah.
you still require $60,000. Hey, you probably need a bit more. You probably need 61,000 because
Yeah.
costs went up.
Yep.
So you still get that 3.64% average rate of return,
Yep.
but it's on a lower starting balance.
Yep.
So your income's gone up,
Yeah.
but your returns in dollar value
Yes.
have gone backwards,
and
have gone down.
And this is what we talk about. Why this is for us, because we deal in this all the time. We can see that this is, for most people, the biggest risk that they need to be aware of is that you can see very quickly that if you start with a capital base of your retirement savings and in that first year you dip straight into that, every year that goes on, things get more expensive with inflation, and that's kind of what we talk about, purchasing power risk. Your costs are going to go up every year. Things get more expensive every year.
Yep, absolutely.
And you're having to draw more income out of a shrinking retirement savings balance. So your $1 million has dropped to 975, and then next year it's 950, and every year your costs are going up and up and up, and your return on that is going down and down and down.
That's exactly right. So basically, if you fast forward to, so you would have had to do one of two things. You would have had to keep taking $60,000 indexed to inflation.
Yep.
At which point, at
you'd
the
be
end
running
of
out of money.
2019, you're almost out of money.
Yep.
So I haven't done the exact sums on that, but you have
bad.
roughly $100,000 or less.
The technical term for it is bad.
It's bad. It's bad. So I mean, I think certainly that's extremely risky.
Yeah.
Because you'll almost run out of money 10
Well,
years into an average 30-year retirement.
Yeah. Well,
or the other option, part B of that,
Yeah.
is that you would have had to have shaved your income that you can draw from your fund
and live on
down from $60,000 to $36,000.
Yeah. And just live on that.
And live on that. Now, I think that's extremely risky as well. Obviously, that takes away any travel. It takes away so many choices.
It's probably one of those things where you go, it may not necessarily be risky, but geez, it's not fun.
It's not fun.
Very unpleasant for most people.
Yeah.
And I guess the other thing is not realistic. Is the other one.
And not realistic.
Is that if you were to say, I don't want, again, when I said it's not risky, that's probably not true, because as you said, you can't take away that risk, you can only shift it. If you said, I've got that $1 million, I want to be in the lifetime sustain 2 option because I don't want any market risk. I want that very what I consider a safe return, and I don't want any purchasing power risk. So what I'm going to do is I'm just going to spend the return on that money. The risk that you have then is your retirement looks nothing like you want it to be. No one's sitting there going, geez, I'd love to be living on 30 grand a year in retirement. It's just not what people want, and so the risk is that you can't live the lifestyle you want.
It's really difficult Dallas, to talk to people about their retirement and for them to visualise themselves living 30 years in their retirement and living a healthy 30 years as well.
Yeah.
So we all know how fast this last decade went. We're in 2020 as we record this in January 2020.
Yeah.
Everyone listening, I'm going to say, has said, where did that last 10 years go?
Yeah.
Because it's the thing that so if you retired in 2010, when you picture yourself as a very old person 10 years into your retirement, you're not.
No.
Yeah, you're now here in 2020. You're still a young person.
Yep.
You still have, on average, the ability to travel overseas.
Yep.
You have the health to do that.
Well, and
you just don't have the money if you're in the wrong fund.
That's right. And that's, I think, you see a lot of these things with the trade-off with these risks. Because when we talk about this with people, is that it's an uncomfortable decision to make. So it's easier. People make and this is a very common sort of joking comment that people make to us, where we go, okay, well, if you're going to get that return, if you're going to get a 3.6 return moving forward, you're going to run out of money in 10, 12 years time, and you'll be 77. Oh, that's right, I'll be dead by then.
Yeah.
And you hear it again and again, and then you say to that person, well, are your parents alive? Oh, well, mum's still kicking and she's 92. Okay.
It is, like, it's really, really difficult for people to picture themselves, spending a long time in their retirement.
Yeah,
it is. So alternatively, we started this business back in 2010.
Yeah.
And the people that we took on as clients that were retiring at that point in time or working towards their retirement. Look, for 99% of them, we had the discussion. In fact, we had the discussion with 100% of them, but for 99% of them, look, it became something that they just had to get their head around, that we needed to accept some sort of market volatility. Because they just didn't have the resources, either the length of time between now and when they were going to retire, or the disposable income or the superannuation balance. They didn't have the disposable income. They didn't have the resources to be able to succeed with a 3.64% rate of return on average. So we needed, we've always set a target with our clients conservatively of we want to achieve a return of an average of 8% per annum. Net of all costs. So and that's the return that most, it's not that we're singling our clients out and saying this is your problem. It's the problem of 97% of retirees in Australia.
That's right.
There's a limited 3%, I'm guessing, that have the financial resources to be able to accept a 3% rate of return.
And that's exactly right. Is that if someone came in to see me at 65 with $20 million in the bank and said, I'm just going to put that in a term deposit and get a 2% return on that, that's fine. If you and they want to spend $100,000 a year, they're fine. They're never going to run out of money anyway. The reality is most people cannot afford to make that decision. And that's, I guess, the point that we're making here is that that's a decision that needs to be made. It's not magic.
It's not magic.
It's a trade-off.
It's a trade-off, and it's a discussion. It's a decision that needs to be made. With the high growth fund that we've selected, which is well and truly diversified, I really can't go into the investment strategy of that now, because it could be seen as giving advice to people that I haven't met. That's actually averaged over that same time frame a 9.12% rate of return per annum. So these people live a very different retirement. So they started with the same $1 million, but instead of getting a 3.64% rate of return, they got a 9.12% rate of return on average in that first year of the retirement. They made $90,000 as a return, and they spent $60,000. Year two,
$1,030,000.
They started with $1,030,000.
And
they got a 9.12% rate of return. They made a bit over $90,000 again, and $91,000. And they spent $61,000 in the same example. So they started off on the right foot, not on the back foot, on the front foot.
And that's a great point, because in that first, where I think this is dangerous is in the first year or two, it probably doesn't look that different. So at the end of year one, a couple that followed the strategy, that they've got $1,030,000, the other couple's got 975. They're probably both thinking we're in the same boat, roughly. But very quickly, you go, one of you is the trajectory of where you're heading is not good, and the other one, you will never run out of money.
That's right.
And that's kind of, obviously this is all very simplified, and as you said, we can't get into too much detail about that, but this isn't magic of what we're saying here to get a higher return. It's not that we're geniuses who can pick and choose where's this U-Butte investment. It's just about having an adult, rational discussion about, okay, well, do we need to accept more volatility, more of that market risk, so that we minimise the impact of purchasing power risk and minimise the likelihood of you running out of money?
That's right. And has our high growth fund been more volatile than the Q Super Lifetime Sustain 2 fund? Absolutely. Absolutely. So there's been times during that 10 years that it's dropped by a significant amount. And that's another discussion that we have up front with our clients as well. We say, it is at times going to drop up to 57%. Because that's what happened with the global financial crisis. It was a drop of 57% nominally and temporarily before it rebounded and has grown to new highs. But I think that's what we have.
That's a good point as well, because what you find is that when we're looking at such a short time frame, again, if you look at over the course of that first year, the people who are on track to run out of money, getting a 3.6% return, and that's just the facts of, like we said, if they draw that income out and get that return, they will run out of money. They probably feel very comfortable, because at the end of that first year, the higher growth strategy, it might have we say they got a 9% return, but as you said, it's not a nice, neat.
No, this is an
every
average.
Year. This is so at the end of that first year, their $1 million might have drawn $60,000 and it might have dropped to 800,000.
Yes.
And so you can sort of see why people go, well, this is terrible. I don't want that.
Yeah,
I
absolutely.
want the nice smooth line, even though it's a nice smooth line down into nothing.
It's down to nothing. Yeah.
But that's, I guess, a part of that trade-off is why this is such a hard decision to make, is that it's easy to get focused on the short term and on the worry about that short-term movement rather than looking at what's the likely trajectory of my retirement savings and what do I want to happen over the next 30 years.
That's right, and they're fighting the wrong dragon, really, aren't they?
Yeah.
So they're fighting the market risk dragon because they think that's they think the closer. Yeah. And again, our industry is at fault here.
Yeah.
Because they have told people. Yeah. And there's been a rule of thumb. Yeah. The closer you get to retirement, the lower risk you want.
Yep.
And that's why I thought it would be a good topic, because you can't take that risk away. You can only shift it to other areas. So lower risk. Oh yeah, I'm in a lower risk fund.
Yeah.
Hey, that's only returned 3.64%, which was half of what I needed.
Yep.
So over the first 10 years of my 30-year retirement, I've actually run my money down to virtually nothing. Yeah.
And that's, again, it's not to, the point of what we're saying today is not to say, hey, forget about market risk completely, forget about volatility, it doesn't matter, because it does matter. You know what I mean?
Matter, yeah.
The reality is that it's still a part of it. We can't, again, if we sit here and go, oh yeah, we've got a nice neat 9.12% return, that's not the reality of what happened. It goes up and down.
It's absolutely not the reality.
But a part of our planning is about going, these are the two risks that we really need to think about with our retirement savings. We need to have a discussion about what the trade-off is that we're willing to make. Yeah. And then we need to, whichever one of those risks we have accepted more of, we need to adjust the plan based on that the level of each of those risks involved. So if you were going to be 100% invested in growth assets and you go, I'm going to take on all market risk, no purchasing power risk, well, you have to have a plan in place for when those drops happen.
That's right.
And when things are going, when there's that boom bust cycle, because that's the risk that you've accepted.
Exactly, and it's a when, not if thing.
That's right.
It's when the market falls.
Yeah.
And when my investments drop 30%.
Yeah.
Or 40%.
Yeah.
Or 57%.
Yeah.
Temporarily, then what am I? What is my strategy then?
Yes. Yeah. And that's exactly right. But I think what happens is most people are. That's a risk that's front and center in people's minds, and they're aware that there's decisions that need to be, or a plan that needs to be put in place for that. Whereas when you're talking to people about the running out of money risk or purchasing power risk of, okay, you've got your money invested in a way that you've got 3.6% return. You are going to run out of money in 12 years' time. What are you going to do? And they make a comment, I'll be dead by then. You won't be. That's not planning.
It's
for
effectively
that.
burying your head in the sand, isn't it? Yeah, because you're saying I don't want to make a decision on this now. It's become too hard to make a decision. Yeah. So I'll bury my head in the sand effectively.
Yeah. And that's, I guess, all we're talking about with all this risk, and that's why I think it's a great title, is that you can't take it away. Either of these, there is no magic bullet that we have as an advisor. It'd be fantastic if we had some way to, and it's sort of a bit of a running joke in our industry, when someone promises growth asset returns without the volatility. Yeah. No, you cannot have that. Anytime someone promises you that, you should turn around and run the other way.
Yes, don't walk, run. So absolutely, because there is, we're very careful to have that discussion with people and have that trade-off. There will be volatility, and hey, we're not lunatics. So a lunatic would say, let's take on all this volatility for the thrill of it. But why volatility would be taken on is because a higher return is required. With someone's level of resources to be able to fund their likely 20 to 30 year retirement.
That's right.
As opposed to running out of money in the first third of their retirement. So I just had another thought, but it's gone now. Say something, Dallas. Sorry, I've got it now. So this isn't a bagging of industry funds. No. However, and this is a government problem. Legislation has come in recent years from the government to say that people that in superannuation funds and haven't made an election as to where they want their money invested. So they've just gone into the default fund.
Yeah.
Those funds have to offer a My Super option. Yeah. Now, most of the time, those My Super options are what they call or what they refer to as a target dated fund.
Yeah, which is exactly what we're talking about here.
And what we're talking about here is as you hit certain age brackets, they're going to change your investment strategy. Unbeknownst to you sometimes. They probably will send documentation, but not always. And you probably won't read it. But they're going to change your investment strategy into a lower volatility, lower returning strategy over time. So, for example, Q Super Lifetime Sustain 2, which is the fund that we have quoted here as earning an average rate of return, as per Q Super's website, of 3.64% per annum for the decade to 31st of December 2019. Again, on Q Super's site, it says if you're over 58 years old and have a balance of more than $300,000, we will invest your money in the Sustain 2, the Lifetime Sustain 2. This option is designed for short-term investors who are close to or in retirement. So,
which just doesn't make any sense.
Hear their language.
Which doesn't make any sense.
So you're a short-term investor who's close to or in retirement. Now, I can appreciate where Q Super are coming from. So they've got a bunch of, customers. I'd say customers, not clients. A bunch of customers that have been defaulted into their fund. Because they've worked for the government. The state government in Queensland. They are a potential. I mean, what Q Super is doing here is covering their own backside. So they're basically saying, there's all these people that have been pushed into this fund. We're going to assume that not many of them know about market risk and volatility. And if we on our report show them that their funds dropped by 30 or 40%, then we have a liability on our hands here waiting to happen. So what we'll do is we'll just make the blanket assumption that as they get older, the lower volatility that they want. And as we know, though, that comes with lower returns. Now, no one's, as far as I know, no one's ever been sued for low volatility, low returns. I don't know if they have.
But it would be an interesting one because, as we said, they are not. You notice that there's nowhere where they're saying there's no risk. What they're effectively doing there is transferring that risk from volatility to running out of money risk, and that's exactly what we're talking about. And I think that this can be frustrating sometimes. With it often sounds like we're canning industry funds, but we can every fund who uses the same sort of language, which is that we can magically take away all the pain, and that's not how it is. So what you find is. And this really is frustrating when you look at. I've written blog posts and articles and all sorts of things about this. When you see an ad on TV where they go, "Our fund returned this amount," your fund did nothing of the sort. Your default or your balance fund or whatever it is, it was invested in a range of different asset classes. Some of them are higher volatility, higher return. Some of them are lower volatility, lower return. The mix of assets that you were invested into is the real determining factor for what was that return. Whether you just happened to outperform, if it doesn't actually matter in terms of you might have jagged a lucky year or not, and also what return you got in that year. That doesn't tell people whether they're going to run out of money in retirement or not.
Absolutely not.
That tells them nothing. It's just an easy metric, and human beings, we love to just have a metric that we can jump on. So it's easy to go, geez, Sun Super did this, or MLC Super did this, or none of these super funds are actually doing any of these things. No. They are just replying to the mandate of our government and our society. So this is, I guess, the thing of, it comes back to something we talk about a lot, which is that as someone planning for your retirement, you have to have an internal locus of control. You are responsible for your retirement. It's not enough to throw your hands up and go, oh well, Q Super's taking care of that for me, because they're not taking care of that for you. They're not. All they're doing is responding to what I would consider sort of career risk of, geez, we don't want to rock the boat. We don't want to have the hard conversation with people about saying, hey, you need to take on some more volatility because you are going to run short of where you need to be to retire. They're just not having that conversation. They're going, it's just easier to keep everyone happy and invest in this way.
That's right. Yeah, 100%. And yes, and also to be fair to QC, but it's not just them, it's everyone.
No, that's right.
So look, if you're listening to this and at any age, but particularly in your 50s, and you haven't made a nomination as to where your superannuation funds have been invested, and I'm not talking about whether you're invested in Q Super or Sun Super, I'm talking about the investment strategies inside of that, or if you see My Super anywhere on your statement, and again, I'm not saying these are necessarily bad, but you have to look deeper into it. You have to deep dive now into that and say, okay, what is this thing actually invested into?
Yeah, what mix of assets?
What mix of assets? And is it appropriate for me and what I want to achieve?
That's a great point, because you may look at all that, do all the research, and talk to someone about it, and you might in the end work out that the mix of assets that you're invested in is perfect for you, and that's fantastic. But it seems very unlikely, of all of the different options of things that you could be invested into, of all of the different risks that you could trade off, all the rest of it, it's very unlikely that the one that you've been defaulted into is the right fit for you.
Yes.
And that's, I guess, the point that I'd make in sort of wrapping up, is that it's like a lot of things that we talk about, not making a decision is still a decision. So there's a real human tendency to go, I don't want to change out of what I'm defaulted into, because that way if things go wrong, I can point the finger at someone. I can point to QSuper and go, oh, well, they stuffed that up. Whereas if I make a decision and change that investment strategy, then I might have to live with the fact that I've made the wrong decision. And so that's the big thing that I'd say is, most people aren't aware that there is a decision to be made about how that superannuation is invested, but there is.
Yeah.
And so you've got no excuse now. You've listened to this podcast. You know that that's a decision. If you choose to now not make a decision, stick your head in the sand, not sort of think anything about it, or you don't want to think about it, you need to accept that you have made a decision by doing that.
Yeah, that's right. So look, if you'd like help in that decision, we certainly offer a complimentary meeting, and there's nothing hard to sell about us. No. So people come in, they bring their superannuation statements in. We look at it. We ask we have a process where we are able to prompt them and extract out of them what they want to achieve in their retirement, and certainly they leave that meeting informed and knowing what they need to do as the next step.
And that's a good point, that there's no hard sell there, because as we've just said, there's nothing to sell. We don't have a magic bullet.
No, we don't have a magic bullet.
We can only have the conversation.
You'll absolutely go through some pain if you become a client of it. You'll have to give up some money every single paycheck.
Yeah, you'll have to
put into your superannuation
fund. You'll
fund.
have to accept one of these risks. You'll have to accept a mix of them. But I think that's exactly right, is that it's probably good news and bad news for people, is that if we said we had a magic bullet, we've just told people to run the other way. But there's not a situation where people come in and meet with us and we go, we can solve all your problems, get rid of every risk, make it so that you don't have to give up anything. You can achieve all your wildest dreams with no pain at all. Again, that's not. Most people are adult enough to go, that's not how life works.
That's right. Well, and it's silly. I mean, we were just talking about this morning. It's like the weight loss pill, isn't it?
Yeah.
So there is no such thing as a weight loss pill.
No.
But these superannuation funds are reporting that there is.
Yes.
You can have it all.
Yeah. No risk.
So we're certainly, as financial advisors, we're your toughest personal trainer that you've ever had. There will be pain if you end up becoming a client of ours, of course. But
I guess the point is, there will be pain whether you meet with a financial advisor or if you don't.
There'll be pain regardless.
If you don't do what you need to, and you run out of money, 10 years into your retirement, there's pain there as well. Yeah, this is the world we live in. There's pain all around.
Absolutely. So if we go back to those examples, the person with the lifetime sustain fund that earned 3.64%, they're nearly out of money 10 years into their retirement. Hey, our clients that averaged that 9.12% rate of return and took the $60,000 a year indexed. Look, they have way more than they started with right now. They have, it's again, I don't have the exact numbers, but it's well over $1 million.
Again, in technical terms, it's good.
It's good. First one's bad, the second one's good. So, Absolutely, they've gone through pain along the way to get to that balance and to grow that balance. But
their prognosis looks a lot better.
It looks a lot better. Looks a lot better. So you can get in touch with us at Lighthouse Advisors with an E, RS. So Lighthouse Advisors with an E, .com.au. Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Lighthouse Financial Advisors. We look forward to catching up again soon.